And that is one thing that sets the American dairy farmer apart from those in the European Union and New Zealand, because we're all going to start experiencing lower milk prices. But beef on dairy is now contributing $4.50, and on some farms even $5 per hundredweight. And that's a game changer, Ben.
Welcome to the Hoards Dairyman podcast. We are excited to have two guests with us for the podcast today, Corey Geiger and Ben Laine. Welcome, Corey and Ben, and we look forward to the conversation of the 2026 Dairy Outlook.
Kylene, it's great to be with you and be with Ben here and have a discussion on our dairy markets.
Looking forward to the conversation. Thank you.
Ben, when we look at the dairy landscape out here to start the new year, the milk checks that dairy farmers are going to receive are quite a bit lower than they were in the past, especially these last 3 months of the year. What are you seeing in the countryside?
Yeah, it's definitely a difficult start to the year in terms of milk prices. That's for sure. We saw towards the end of last year, we could see it coming. We saw the prices start to fall, and that's where we've kind of settled in, unfortunately, to begin this year. We're used to a little bit of potentially earlier part of the year slump, but this is a dramatic change to kind of what we had started to get comfortable with last year. I mean, I think if we wrap up where we were for a good chunk of last year, it was a situation where we had reasonably high milk prices and feed was relatively affordable. And then we had this nice bonus of the beef on dairy crosses and that extra stream of revenue. So kind of firing on all cylinders. And that was a good thing. Unfortunately, I think it might have been almost, it was good to the point where we've seen, as we tend to do in the industry, we've seen supply pick up pretty dramatically. And we saw that through the summer. Part of it was probably, comparisons to last year or the prior year with the HPAI and the bird flu. But there was genuinely some growth in there too. I mean, we've seen the herd growing, we've seen cow numbers increasing. You've been highlighting that components have been increasing. Now we're increasing both components and milk. So it's tough to avoid that downturn in prices when you're in that kind of situation. I do think that the good thing is, as we start this year, I think a lot of folks were able to take advantage of programs like Dairy Revenue Protection, DMC. A lot of folks have some degree of insurance going through that difficult last quarter and into this first quarter. I'm relatively optimistic that we could turn around. I think it's, a matter of when we see supply sort of rebalance, and if we're able to see prices kind of internationally pick up a little bit, that would be positive. I'm not getting the feeling at this point, at least, that we're in for like a year-long, multi-year slump in prices. I think there's a good case to be made that we could see some weakness to start the year here, and we could potentially see some improvement in the back half of the year. So I think given that it's hopefully going to be relatively contained to these first quarter or two, and that folks are hopefully to some degree insured, they're coming off a pretty good stretch of a year and at least several months of pretty good conditions. So that should hopefully help carry folks through some of this. And we still have the beef on dairy thing going. So that's going to be a nice buffer to help protect some of those margins. Even if it's not directly on the milk side, it's going to help give a little more breathing room, so we don't need to be quite in panic mode as we might have been if we had just seen these milk prices in a vacuum. That would be kind of a different scenario. So I think it's manageable. I wouldn't ignore it. We still do need to be a little bit careful how we manage and look at costs and look at efficiencies on some of these next couple of months, but it's hopefully not going to be as dramatically bad as it could have been. And I am hopeful that we see some improvement in the second half of the year.
I think we got to drill down deeper in that beef on dairy a little bit later in the podcast, because it's a really, if you look across the country, globe, it's a differentiator for the U.S. dairy industry. You're not seeing these kind of returns in the largest dairy export region, the EU, and the second largest, New Zealand. I think the thing, Ben, you were talking about, components have been up, but now milk is up too. If you look at the first 5 months of 2025, January to May, milk production was up like 1.5%, and butterfat production was up 3.5%. And then as you moved in the second half of those, if you look at June to October, butterfat started being up 5% year over year, and milk was up 3.5%. Then came November, and now milk is up over 4%. And we really, from our vantage point, have an oversupply situation. This isn't a demand situation. If you look at overall dairy demand, and it's a $80.3 billion category. So sales of U.S. dairy in retail are up 3.4% as we look at the year-end data here in 2025. I think also more importantly, the American consumer can only eat so much butter, the product. We're just growing so much butterfat. But cottage, if you look at 10 of the 12 categories in dairy, they're up. Cottage cheese has been experiencing double-digit growth. The high protein beverage category is exploding. It's been up 71% in the last 4-year window. Yogurt's strong, up 7-8%. Surprising category, dairy creamers. We talk about the butterfat story, but whole fats, short ingredient list, but dairy creamers are up 7.6%, and whipping cream is up as well too. So the thing we certainly keep our eyes on is cheese demand, cheese being 40% of the market. That's, in retail, it's up 1%, and we both been following, but the pizza situation is one to kind of keep our eyes wide open on, Ben.
Yeah, it's gotten some coverage in the mainstream media, at least. I know the Wall Street Journal did a pretty big piece on kind of the slowing sales of pizza. That's gotten a lot of attention on top of the fact that we saw cheese and a couple other categories. Net, we were down a little bit in terms of per capita dairy demand, and this was lagged data. We're looking at 2024, but you pile that on to some coverage of struggling pizza sales and pizza chains having a little bit of a challenge. I think I've certainly heard a lot of conversations about whether we're at peak pizza or peak cheese. I don't know for sure that we are, but to me, I think there's a lot of moving pieces, obviously. We've got GLP-1s as a big piece of it, and that potentially is very good for protein, but potentially not as favorable to things like pizza and other things that are traditionally what we look at in terms of fast food or quick service or benefits to consumers. But I think the way the lens that I've looked at some of this stuff and some of the developing demand trends, and I do want to stress, before I get too gloomy, I don't mean to be, but I want to stress to your point, demand has been good. Our domestic demand has been good. Exports have been really strong. That stuff's still going. The situation we're in right now, to your point, is it's an oversupply situation, and it's really just that demand is growing. We just can't keep up with plus 4% growth that we are seeing on the production side. We can't keep up with that same pace on the demand side, but it is good. The thing long term, though, that the lens that I try and look at situations like the questions around pizza is, we've been looking at this at Terrain for some time now. Last year we focused a lot on demographic shifts. I did a piece a couple of years ago looking at the aging population in the US. We have to realize that as we're seeing the population age in the United States, and we certainly are, we're approaching the point where we're going to have more people over 65 than under 18. We're going to have more old people than young people in the country for the first time. Our median age as a population is shifting up, and we're kind of shifting out of the pizza years. So a lot of those products that have been favorable and cheese heavy and otherwise dairy heavy have been driven by, kind of 20s and 30s and the things that people in those age groups, when they're the big group of the population, that's the kind of the product that does well. I don't think we have to be done, but we have to acknowledge that the population's aging, and those same products, maybe that chunk of the population that's driving demand is traditionally the younger part of the population, but that's going to be a smaller piece of the population. So we need to kind of just reimagine maybe how we serve those different customer groups as the demographic profile of the population changes. And I think that's a little bit of what's driving potentially the slowdown in pizzas. We're just seeing a population aging out of kind of their prime pizza years.
And there's some things taking place within pizza that one has to take a look at. Some of the larger chains have been sales year over year or month over month have been down. They've been running some specials to help bolster that. There's data out there, though, that the independent pizzerias are doing pretty well. Pizza may have to reinvent some of itself. It was the unquestioned market leader going into the pandemic and in the beginning stages of the pandemic with delivery. And so now we have DoorDash and all these other food categories, and you can get about any food delivered to you, which is a big game changer. Then, if we're talking about GLP-1 weight loss drugs, large pizza chains have largely delivered the entire pizza pie. That may not be the future as we have smaller households, consume less calories, and perhaps there'll have to be some look at selling pizza by the slice or by the half pie as well. So there's a lot of different parts. Mozzarella is still the unquestioned king of American cheese sales and categories and production. Just, I would say the bottom line is something to keep our eyes wide open on, because pizza has been a big winner for the dairy category as well. GLP-1 weight loss drugs, there's estimates, from different sources, 8% of Americans on. Some of the newer sources are at 12%. These have mostly been injectable products up till now, but there's a lot of work underway that move this to the pill form. And that is where dairy can largely win because of our high quality protein that is booming right now. Ben, I know you've studied this quite a while. What's your viewpoint?
I think it's a huge, huge win for the industry. I mean, anytime we see, to follow up on the point about some of the shifts in pizza, I think it's not an immediate thing. It's not like we've suddenly hit this point and things are going to turn around. To your point, we might just need to think about how do we deliver it differently, or there's small shifts in how we kind of look at meeting customers where they're at. So I think it's an ongoing development, but the GLP-1s have been a huge point of optimism, I think, for dairy markets, just because anytime you see something come along that's going to make consumers kind of suddenly shift their demand in a way that the dairy industry is pretty well positioned to be able to meet that demand, I think that's a positive story. And consumers want protein, and we're good at making protein. We've still got the fat to deal with, but we've been for years developing better technologies and better filtering and things like that to get these high protein whey products. And that's been an ideal way to deliver protein, whether it's in protein shakes or bars or other snacks. I mean, there's all sorts of development around products right now. And I think that, if I go into a Starbucks or something, there's all sorts of signage about higher protein lattes and things like that. And I think that's what we've got to do. We got to start shifting with the customers, and we're seeing that. And I think also that's a benefit in terms of not only the folks that are using these GLP-1s, but also just societally, as you're seeing more of these high protein offerings and new exciting products coming out, other people are gonna try that. And I think that people have been shifting towards wanting to consume more protein for some time. So I think we're all of a sudden having several new options for them, and a lot of those are tapping into dairy as their source of protein. So I think that's a very positive story. I know you've looked at more of the kind of individual categories and things that we see in some of the scanner data and things like that. So I don't know what else you're seeing, but to me, it's a positive story in terms of consumers want something suddenly and dramatically, and it's something we can provide to them. So that's a win.
I think we need to remind our listeners the whole Milk for Healthy Kids Act is very important, and it will give dairy new opportunities. But I think from a dairy farmer perspective, what I've been reminding audiences, when we think of whole milk, we may be thinking of 4.4% butterfat coming off our farms. Whole milk is standardized in all states in the United States except for California at 3.25%. California has a higher standard. So even though we would have the potential to move more butterfat through whole milk, it's not as big a number as you think. Now, dairy and protein got a strong endorsement in the 2026 to 2030 dietary guidelines for Americans. Protein was center stage, cheese was center stage, healthy fats were center stage. Now that impacts, Americans could still eat any way they want, but what the dietary guidelines do guide is SNAP benefits. They guide school lunch meals. They guide military food, and that's about 1/8 of all, or at least SNAP is 1/8 of all the food consumption in the United States. So it does have an important impact here. Ben, what are you seeing?
Yeah, I agree. It's it's a win. I think, realistically, we got to, in terms of the dietary guidelines, the new food pyramid, we got some good positioning, at least in terms of cheese and some things like that in there, and that's positive. But to your point, in terms of general consumers, people aren't consulting that food pyramid before they go figure out what they're going to have for dinner. It does have a much more meaningful impact on things like school lunches and other institutional programs like that, SNAP, stuff like that. So it's a benefit in that sense. I think the whole milk for healthy kids and getting whole milk back in schools, that's similarly maybe not going to be an immediate tectonic shift in everybody's, every school kid in America is going to start drinking whole milk. But I think it's a positive step and it allows that momentum to build. So I think, you've got kids maybe who have whole milk at home and will be excited that now it's an option at school lunch and they'll have that. And there's maybe kids that only had milk at their school lunch and will realize, hey, this whole milk is a lot better. And maybe that, builds more foundational kind of dairy demand in that consumer. So I think there's momentum to be built. It's going to be a positive step that hopefully helps drive familiarity with dairy within those consumers, those young consumers, and when they're starting getting introduced to more, closer to the whole milk that's coming off the farm, at least they're getting introduced to that, working that into their own kind of tastes and preferences, and carrying that with them as they move into the future. So I think it's a positive step. I don't think either is going to be as impactful as, a miracle drug coming along that's changing people's dietary tastes and preferences, but both positive steps, and I think that's a good thing. Even if it is on the margins, any kind of opportunity to help absorb a little more of that milk fat that's coming off the farm is a positive.
When we're talking about consumers here, I like to remind audiences that all consumers aren't the same. If you break the American consumer into quintiles, and what's a quintile? Quintile will be putting consumers in 20% brackets. So if you look at the top 20% of Americans in the highest quintile, they're spending about 8% of their income on food, and they're spending $17,000 on food. Now, the decisions that group makes, they're we haven't used the I word yet, inflation. When people are faced with inflation, they make different choices. But that category is largely plowing ahead. That's why steaks and beef sales are still high. And a lot of high-end steaks get eaten in restaurants, not at home. But if you look at the lowest quintile of Americans among us, the group that's the 20% that's the lowest wage earners, they're spending about 32% of their income on food, and that number is only 5,300. What there's top groups at 17,000, the bottom groups at 5,300, and if they want to buy a hamburger at a quick service restaurant, that price has gone up, skyrocketing price of ground beef. Then there's a missed opportunity if they're not making a purchase there. That there's a slice of cheese like not going on it. So these are the different things that are driving different categories. And it's really, for people like Ben and I, you really got to pull this apart and see how demand is shifting. And I think that's a perfect segue to talk about beef on dairy. Any dairy farmer knows the value proposition has changed over the last 5 years. If you're looking at what a day-old beef on dairy calf is selling for, and at least publicly available data in the Lancaster, Pennsylvania market, we're back up pushing $1,400. And that is one thing that sets the American dairy farmer apart from those in the European Union and New Zealand, because we're all going to start experiencing lower milk prices. But beef on dairy is now contributing $4.50, and on some farms even $5 per hundredweight. And that's a game changer, Ben.
That's I mean, it's been building over the years, but it's definitely it's gone from something you had folks that were experimenting with it and dipping their toes into, now better have a good reason if you're not taking advantage of this in some form or another, because it's so critical, and especially to the point where, like we started off with, it's going to be a tough beginning of the year. These are the types of kind of differentiated revenue streams that you're going to need to help carry through some of these tough times. So it's hugely important. I do want to go back real quick just to some of the things we were just talking about in terms of the broader economy and how consumers are feeling, and some of those divergences, because I think that's important. And in fact, I just finished up a column for Hoards Intel, so a little plug on that. But it's very much related to the fact that we've got. It's going to be a pretty wild year in terms of hearing about the economy, just because it's a midterm election year. So we're going to hear all sorts of competing rhetoric about how well or how poorly or how optimistic the economy is looking. We got to take all that with a little grain of salt. But in terms of what it means for dairy demand, you mentioned inflation. Food is always weird because it's got, it's you have to eat. Where people are going to eat, they might cut back in other areas of their spending before they cut back on food spending in terms of total calories they eat, but they do shift where they choose to eat. So that shift from maybe not going out to eat versus and instead making something at home is pretty meaningful to dairy because consumers demand, not necessarily consume, although we do consume more products like pizza or cheeseburgers or lattes when we're eating away from home than when we do at home. But there's also just more waste potentially in some of those dining out and food away from home supply chains. So there's more demand when consumers are eating away from home than when they're eating at home, and that's the risk that we see that shift start to impact folks and make those decisions. I think we haven't necessarily seen that showing up yet, which is positive, but in some of the work that I've done previously, I've looked at how does dairy demand respond to inflation? How does it respond to unemployment? And to me, the job situation, the employment situation is kind of the key piece to that decision of eating away from home versus at home. So consumers are pretty sensitive to how they're feeling about their job prospects. Are they employed? Are they worried if they lose their job, they won't be able to find another? Or are they unemployed? And the unemployment rate's creeping up. It's not moving in the right direction, but it's not historically high. It's still reasonable, but we are seeing more signs, surveys, consumer sentiment index. The New York Fed has a survey on employment prospects where they're basically hitting all-time lows in consumers' optimism that if they were to lose their job, they'd be able to find another. So there's some worrying indicators on just the way consumers are feeling about that, but hopefully we can kind of keep that as we move through this year at bay, because that is the unemployment piece is what I try to focus on in terms of how are consumers going to potentially change their behavior in terms of their dairy consumption patterns, their choices of eating at or away from home. So just a little aside on that. But in terms of the beef on dairy, yes, it's huge. It's going to continue to be good. I think we've got a long ways to fall, really. If prices for beef calves or any of the beef cattle side of things fall, we've got some room to fall before it's anywhere near where it had been previously. So it might not always be this great. It's rebounded recently, but who knows where it's going to go. But even if it gets cut in half, it's still going to be a pretty good deal compared to where it has been historically. I think on the supply side, the interesting thing to me this year that wasn't on my bingo card was seeing how the milk cow herd has grown. And I think a lot of that, the fact that we're hitting milk cow levels that we haven't seen since the 90s, but we don't really have the replacements. I think, me and a lot of folks had been looking at this year and thinking we don't have the replacements available. It's low replacement ratios. How are we going to be able to grow this herd? Producers have shown us that they'll just hold on to the cows for an extra lactation, maybe just in a lot of cases to get that extra beef calf, and that changes the economics. So that's really driven not only revenues, but it's also kind of indirectly driven total milk supply. So it's really gone from something, the beef on dairy situation has gone from something that to me was kind of a nice little side revenue stream and very important at times like this, but it's actually grown to the point where it's actually driving our operational decisions on the farm. It's driving the supply side of the milk market right now. So it's a very unique situation to be in. I don't think it's going away anytime soon. It might not, as I said, always be quite as sweet a deal as it is now, but it's got some runway still. And even if it falls, it's got a ways to go where it's still going to be pretty favorable and a big piece of what a lot of folks do, I think.
Barring a recession, we should see strong beef prices for the next 2 to 3 years. Whether there'll be ebbs and flows to that, as you said, that certainly will take place. But we're in a strong demand situation on beef. And, we're at a point now that the value of the cow's uterus for that black-hided calf is higher than the cull cow itself, and hence we're at 9.57 million dairy cows, as you talked about. And the offshoot of that is 50 to 60% of this new milk production year over year is becoming from the fact that American dairy farmers have over 200,000 more cows than they did a year ago. That is driving the milk price situation. So it's a good news and a bad news story in many regards. Moving on, I think this all dovetails into international prices. We've been October cheese exports from the United States were a new record number. We're going to probably have a record year for cheese when we get November and December data in. We're having one of the strongest years for butterfat sales. Now, some of that has been driven, we've had talk a lot about trade tribulation and tariff tribulations that are out in the marketplace. But the U.S., among the big three, was the lowest price in the world market for cheese and butter. If we look at the big three, just for the audience sake, the European Union, 1.6 times the American milk production supply. The EU exports 20% of their milk production. Then comes New Zealand, about 6 million dairy cows on a couple islands with 5 million people in a space about Illinois and Wisconsin, exporting 95% of their milk production. And then comes the U.S. at about 17 to 18%. U.S. milk prices are pretty dynamic. They change. They get reported on the Federal Milk Marketing Order System every month. We got CME. We got robust risk tools that have been alluded to. Europe doesn't quite have that. In New Zealand, Fonterra, by far the largest co-op marketing over 90% of the milk supply, pays out on kilograms of milk solids. Now, they forecast the price throughout the year, and on November 25th and December 17th, lowered that price to dairy farmers just because what's taking place in the world stage. Europe's a little bit more negotiated prices. But I think, at the Global Dairy Trade Platform, trades, it's a great barometer to Southern Hemisphere. And those trades take place on the first and third Tuesday of the month, so twice a month. But we had a record 9 trading sessions dating back to August that were down in New Zealand. EU prices are coming down. So we're in a global oversupply situation. It'll be a little bit what region blinks first on the pullback. I don't think anybody pulls back right away, but with the lack of income from beef on dairy, my bet would be that we'd see some pullback from the EU maybe late in the first quarter, early second quarter. Ben, it's anyone's projection on this. What are you seeing in those international markets?
I mean, I think there's a long-term and a short-term aspect to it. I think that, when we think of the situation we're in now, the low prices, the oversupply situation we're in now is because, the three of us, the US, the EU, and New Zealand are all pushing forward and seeing big gains, all kind of for their own reasons, though. And I think part of the situation in Europe, they were dealing with blue tongue disease, and far from an expert in it, and haven't been following it extremely closely, but it definitely impacted them similarly to where bird flu was impacting us. So there's a little bit of kind of comparison to a difficult prior year that's responsible for some of that growth. But also, my understanding is some of that impacted their calving schedules. So there's maybe a little bit of build up and then sudden calving that drove the near term boom in Europe at least. But long term, if we look at both Europe and New Zealand, they're both limited more firmly by a lot of regulatory aspects. I know in New Zealand, dealing with clean water issues, they've got a lot firmer kind of limits to their potential growth going forward. So there's going to be good times and bad times. They're going to have some growth and some tougher years, just like us. But I think on balance, both EU and New Zealand are limited in their kind of long-term growth prospects, much more so than us. And here in the US, the difference is we've been able to grow. We've got the room to grow if the markets are demanding it. And the piece of the market that's really enabled a lot of the growth that we've seen in the past decade or so has been the export market growing. And it's kind of a double-edged sword. There's the the good aspect that that's allowed us to grow. But on the flip side, it does open us up to that global market volatility. So it's something that we've got to contend with. And to your point, I think it's a great point that we've got these other aspects that can help us potentially get through some of that volatility. And part of that's things like beef on dairy, and part of it's things like the more developed risk management options we've got. So they're different markets. Right now, everybody's positive in terms of growth, but I think that eventually we'll see that rebound a little bit, and I think the long-term opportunity is there for us to continue capturing more of that global market share.
Drilling is to freckle down deeper into that beef on dairy. If listeners out there may be asking yourselves, well, the EU has cull dairy cows. The EU could be doing beef on dairy. The difference is there's not many sources in the world of corn-fed beef. A finished feedlot, the steaks that the American consumer and high-end consumers around the world, we export quite a bit of beef to high-end markets like Japan and South Korea. So there's not that upside opportunity there. Some of the best, obviously, the U.S. is the leader in that, but you can source it from Australia, somewhat a little bit in Brazil as well. And but coming back to milk prices, for one last final comment on the EU, quotas came off in 2014, and the EU saw growth in milk production. Then it kind of leveled off, and we've been kind of coming to expect kind of level growth. Ben outlined the issues in the EU, but what happened here in July, after being pretty consistent, all of a sudden in August, September, and then October came rolling around, and EU milk production was up for 5.6%. Preliminary data is showing about 4% for November. In Germany, which is the California of the European Union, was up a whopping 6.8%. So there's just a lot of milk production coming out of the EU right now, and that's putting more product out in products and ingredients out in the marketplace. Coming back to the U.S. here, kind of bringing this back, what's this all mean? We've seen a significant downturn in the futures market. August 1 CME close, you could have got any class 4 contract for over $19 a hundredweight, certainly class 4 being the butter powder market, specifically non-fat dry milk. And then class 3, while contracts were all above $17.50 and some nipping at $18 between January and July, and these were August 1 trades. Now you're looking at, these early months of the year at $15, $16 and some recovery at $17. There's a lot of these new cheese plants running at capacity to this day because that end product, you making cheese, but the high-end protein is in such demand. Whey protein isolates, which is 90% or higher protein, that kind of the top powder category, is selling in the $12.50-ish range, which is pushing record highs. And so there's some good news into this story, but there's going to be some downward pressure on milk prices in this first and second quarter of the new year. And that will, again, put some pressure on dairy farmers across the United States. Ben, what are you seeing?
Yeah, there's definitely the decrease in prices as we saw. I think the other story is kind of this reversal in protein and butter fat values. And of course, we're not, for the most part, producers aren't paid for milk per se. They're paid for their components, and those component values are reversing. And it's driven by a combination of the fact that we're seeing, clearly an oversupplied market of fat and some weakness on the butter price. The butter price was sort of the first to go, and it tied back into the world market story where, the more that we rely on these exports, the more we kind of tend to follow their prices. So we saw the global price of butter start to fall, and we fell shortly thereafter. We saw the cheese prices fall internationally, and we fell shortly thereafter. But the butter collapse happened kind of more suddenly and more dramatically than cheese, I would say. And so we've seen fat values fall, and relatively we've seen protein values strengthen. One thing that I've been trying to pick apart that I think is important for a couple of reasons, but my expectation, and I think most folks are expecting, that protein is going to, in terms of components on the milk check, the protein value is going to remain higher than the butter fat value, the milk fat value going through this year at least, and potentially further. That might be the norm going forward. The thing that I would caution against is that we've got sort of these two stories, both positive. One is we've talked about how strong demand for protein is right now. Consumers can't get enough of it. And that's happening largely in the form of whey protein concentrates, to your point. The other piece of it is we've got high protein values on milk checks. The thing I think is important to dig into, again, with everybody's milk pricing might be different, but in terms of how the federal orders value protein, it's not connected to the whey price. The thing that drives the protein values are cheese and butter. And so whey prices can go through the roof. Consumers might be demanding whey proteins in their beverages and things like that. Whey protein prices could go through the roof, and it wouldn't impact the protein value on milk checks in terms of the way that federal orders value those components. What does impact it is the cheese price. If cheese prices go up, protein prices go up. Unfortunately, they're going down, and maybe partially even because we're trying to produce so much whey, we could be making a little heavier cheese supplies. But butter, interestingly, is inversely related. So if the butter price goes down, which it has, that just kind of mathematically raises the protein value. So a lot of the protein price strength that we're seeing on milk checks right now is actually driven by the fact that butter prices are so low. If we saw nothing else change, but we saw butter prices come up, the protein price would fall again. Fat values would come up. That would be positive. But I think we got to be careful of tying the high protein values we're seeing on milk checks to the high demand for proteins in the marketplace. Because for two reasons. If we're doing risk management in terms of managing components with whether it's DRP or another strategy that looks at component risk, you don't want to hinge that strategy on strong consumer protein demand going forward, which I think there will be. You want to be aware of what drivers, what movements in some of these product demands could change that risk management outlook. So I think it's important there, and it's always valuable, just as complex as it is, to think through your milk checks. And as we're seeing big shifts in consumer demand for protein and fat and all these other components, understanding how that value is moving back to your milk check is always important. So it's something to be aware of. For now, though, it's a positive story, so I don't want to dwell on it too much. Just a little bit of word of caution looking forward is understanding what's driving that milk check protein value. And it could be different for everybody, but in terms of federal orders, it's not necessarily the same factors that are driving consumer demand for protein.
Well, dry whey prices do contribute to class 3 prices, but not nearly at the impact of cheese. Cheese does certainly class 3.
It's through other solids, right? Too. That's the interesting part of this is the way. Well, to your point, it is positive for milk prices, but it's driving the other solids price up, and it's not really. Are we incentivizing higher other solids production on the farm? I'm not sure that's really what the market wants to do. So it's a positive time, but it's getting kind of shuffled through the federal order formulas in some interesting ways. But yeah, it's a good point that it is still pushing that class 3 value up.
As we come to the close of our podcast here with Hoards Dairyman, I would encourage readers to go back and look at the January 10 article by Chad Neckow. He did a wonderful job describing we're seeing a shift in the protein to fat ratio. Speaking of cheese, you need a protein to fat ratio of about 0.8 to make good cheese. If it gets below that, you make soft cheese. And so what is a cheesemaker faced with doing? You got to spin off sweet cream, which is butter fat, or you got to add milk protein concentrate or ultra filtered milk, which is a higher protein dairy ingredient. All this draws off more protein at a time when consumers are demanding it more. And Chad's article really talked about that protein to fat ratio. We have made American dairy farmers and dairy farmers around the globe are really good at going towards incentives. And we have incentivized butter fat so well in recent years, and Ben's outlined what its value to milk check. But when Chad talked about was how many tools do we have in the toolbox to improve butter fat? We have a lot more. We have genetics, we have nutrition, we have a lot more feeding options. When it comes to protein, and we don't have as many tools, and I'm talking economical tools, something you can feed and actually make money on. So talking to the Council on Dairy Cattle Breeding in the contemporary gains in butterfat, when I say contemporary, think about the last 10 years, 61% have come from genetics for butterfat. That means, if I'm doing the math in my head, 39% are coming from management, nutrition, and that. When it comes to protein, 72% of the gain, as Chad, and go back to read that Chad's article, came from genetics. So if we want to improve protein more, it's got to be done through genetics. Unfortunately, in one of the charts in Chad's article, the bell-shaped curve, we have a lot more variation in the Holstein and Jersey breed on butterfat than we do protein. So these two traits are correlated at 80%. If we're picking one, we're going to get the other no matter what. Just not as much tools in the toolbox to improve protein, and hopefully over time we'll change that. But bringing this home, what does this all mean to the dairy farmer? Dairy margins are under pressure right now. We could see some dairy margin coverage insurance payments coming up here as the margins in that calculation fall under the 950 range. And it's not because feed prices have gone up. It's largely driven by lower milk prices. Ben?
Yeah, no, I think feed costs should continue to be reasonable from everything I can tell. So I think that'll continue. I think that the margin story is important though, and the milk piece of that margin is what's coming down and starting the year in a challenging situation. But to bring it back to kind of my outlook that I shared at the beginning, I think that it's hopefully going to be isolated to the first half and that we can see some improvement. And largely what will make this a manageable downturn is the fact that a reasonably good percentage of folks have managed their risk in one form or another moving into this. And I think right now, when you're at sort of the bottom, hopefully the bottom, I expect we're near the bottom of where prices are going to head, but that's not a great time to be locking in new risk management positions. But I think it does highlight the fact that, we do need, and you mentioned it earlier when you saw where futures prices had been relative to where they are now, there are opportunities. You got to look for those opportunities. Not much to see when you're at the bottom, unfortunately. But as we do see, hopefully, some improvement later in the year, keep this with you to try and remember to be looking for those and think about how can you protect yourself out into the future. Because the more we rely on global markets, we're going to continue to have this kind of volatility, and we got to look for as many opportunities as we can to manage through that. And that's partially risk management. It's partially looking for other revenue streams like beef on dairy, and you put that all together, and hopefully that even in an environment of lower milk prices, hopefully that's a strategy that can carry folks through.
Well said, Ben. Kylene, it's been a great opportunity to be here on the Hoards Dairyman podcast. Ben and I both appreciate that opportunity.
Thank you.
Thank you very much for joining us today, Ben and Corey. This has been really great and really good information for our audience and everything you've covered for the 2026 outlook. You've been listening to dairy economists Corey Geiger and Ben Laine. If you want to be the first to catch these conversations, make sure you're following us on YouTube or your favorite podcast player so you don't miss a beat. If this episode added value for you, send it to someone who'd appreciate it too. Corey Geiger is the lead economist for dairy production and processing with Cope Bank. Prior to joining the Farm Credit System, Geiger was the editor here at Hoards Dairyman for nearly 3 decades. He led the launch of the publication's 4th language edition, Hoards Dairyman China, and traveled to 48 states and 4 continents, covering dairy farming and dairy processing. In greater industry service, Corey has served as president of Holstein Association USA, director and chair of the Education Committee for World Dairy Expo, director for the Council on Dairy Cattle Breeding, board advisor for U.S. Farmers and Ranchers in Action, and director for Wisconsin Veterinary Diagnostic Laboratory. In addition, he recently accepted an appointment as a board advisor for the National Dairy Checkoff managed by Dairy Management, Inc. Ben Laine is Terrain's senior dairy analyst. His previous experience spans more than 15 years, trading dairy commodities and covering dairy markets, including work as a dairy analyst for Rabobank, a senior economist at CoBank, and a commodity hedging manager and economist at Agrimark Dairy Farmer Cooperative. His research has spanned the dairy supply chain, risk management, in consumer trends and export markets. Ben earned his MS in Resource Economics at the University of Massachusetts Amherst. At Terrain, he focuses on developing forward-looking strategic insights to help Terrain's farm credit partners and their customers navigate an ever-changing landscape.
Thank you for listening to the Hoards Dairyman podcast. Follow us on Apple Podcasts, Spotify, or your favorite podcast app. And don't forget to like and subscribe on YouTube. See you next time.